Welcome to Trade Ideas. I'm Alex Rosenberg here with Jessica Rabe, co-founder of DataTrek Research. Thanks so much for coming in, Jessica.
Thank you for having me.
Sure. So you're here because yesterday was one of the, I think, the worst day for stocks 2019, down just about 3% in the S&P 500. We're recording this in the morning, bouncing back a little bit, but we'll see what happens through the rest of the day. But you've done some really interesting research on down days in particular, what down days tend to mean for stocks over the next week, over the next year. So maybe you can help us figure out a little bit about how investors should think about down days like this and how to allocate going forward.
Of course, yeah. So yesterday was almost down 3%. That's actually not particularly uncommon when you look back in historical terms. It really takes a down 4% day on the S&P 500 when you can really find an investable entry point. So we went back and we looked at all the down 4% days over the past 60 years, which is the full data series for the S&P 500. What we found is over the next day, it's playing out how it is actually today. You pop a little bit, maybe 100 basis points higher. The next month, you're actually flat, but over the next year, you're actually up 20%. So I would look for more volatile days, not so much a down 3% day, but actually a down 4% day, where you can actually buy at the close and find an investable entry point that, you're up on average over the next year, 20%.
Another thing, this is coming in the context of part of maybe the reason that this day seemed so shocking is it's in the context of a very still pond, and then you get this rock tossed into it. But normally it's a bit more of a ocean current, to use a tortured metaphor here. But what I'm trying to say is that we've had very little volatility this year in comparison to years past. I know you've taken a look at that as well.
Yeah, that's very true. It's been actually very little volatility, which is really unusual to be mid to late cycle where we are economically. So if you look back in history, there's usually 53 days in which the S&P 500 rises or falls by 1% or more, a 1% day every week of the year. This year, there's actually only been 20. So the Q1 average is 13 and the Q2 average is 13, but they're only 11 in Q1, they're only 7 in Q2. So we're running very much under pace. Even over a month into the Q3, where there's again 13 on average, there's only been 2. So actually what you saw yesterday was more healthy market churn.
And does this market churn, do you think that this could lead to a period of more closer to the average or even above average volatility? Is that, does volatility tend to cluster like that? And so you wouldn't be surprised to see more, 1%, 2%, 3%, even 4% days in the weeks to come?
Absolutely, and you're seeing that today with the bounce back. So as much as there's been 41 down 4% days over the past 60 years, there's also been 42 up 4% days. So both unusual, but both tend to cluster together. And if you look back at the years in which that's happened, they all cluster together over, you think 2008 during the financial crisis, 2011 during the Greek debt crisis, the dot-com bubble in the early 2000s, 1987 with the market crash. There's actually as much as a down 4% day is a signal of an investable bottom. If you look at days in which the S&P has actually risen by 4%, they tend to cluster together. So if you invested on a day where the close was up by 4%, the next year it was up by 17%, not as much as a 20% as the down 4% days, but still up by 17% over the next year on average.
So you basically have seen more volatility, and since stocks rise more than they fall, the more volatility tends to lead to more, bigger returns, just because stocks tend to rise and more volatility, tends to bring you higher, I guess.
That's right, and we expect more volatility to continue, more market churn as much as we're having a bounce today. If you look at the VIX, when it peaks or bottoms for the year, back to when it was created in 1990, it's peaked the most in August. We've been warning our clients for a while that expect more volatility in August, and it sure happened very quickly at the turn of the month. So the VIX has peaked 5 times for the year in August, also 5 times for the year in October. So it takes until November where it sort of starts to calm down. December is the quietest month of the year, with actually bottoming 8 times for the year. But August and October are historically very volatile, and especially August, just due to even lower trading volumes, people going on vacation, et cetera. But we expect a lot more market churn in the next few months because of that. And then come November, it should start to abate.
And these warnings about August, this is very interesting, started toward the end of January as you were looking at what, because we obviously had a very good January after a very bad December, and you were looking at what good Januaries tend to mean for the rest of the year. So I'm trying to wrap my head around how you're able to predict the rest of the year based, month by month, but maybe walk us through some of what you were looking at then and some of maybe why that methodology might work.
Of course. So we had a terrible Q4 of last year, December, as you said. So January we had a major snapback. January was up by 7% return. That's one standard deviation above January's return, going back over the past 60 years. So we looked at all the Januaries in which S&P, like this year, has risen by over one standard deviation above the January average. It's only been 8 other years. It's very uncommon. So then we looked at all the months after and how the S&P 500 has performed, and we found that February through July, each month, that momentum carries through. So you're up higher through July. Come August, and this fits with all the volatility data, you start to be down, anywhere from 10 to 50 basis points from August, September, and then down on average 2.5% in those 8 years in October. But then you also, again, fits with the volatility data where volatility abates and you start recovering in November through December. So on average, during the years in which January, the S&P 500 has returned above one standard deviation above the average, on a total return basis, you're up an average. Those years have been up an average of 27%. And all of the years, except for one, were up by double digits. The only exception is 1987, and even that, people forget, was up 6% on a total return basis.
Yeah, that was a crazy year because the market just went up 20%, came down 20% one day, and then just kind of ended flat from there.
Yeah, and the playbooks worked really well this year. Just like the S&P 500 has been up from February through July for each of those 8 years. It's worked every month this year except for May because of trade concerns. We were down over 6%, but we had a snapback in June, and that carried through July. And now, of course, we're getting more volatility, but we do still expect to end the year higher by double-digit returns in line with that January playbook.
So with that being said, should people just kind of hide out until maybe November 1, until they're starting to put together their Thanksgiving plans? Or are there signs people can look forward to that maybe it is a good time to get into stocks again? What signs would you be looking for?
Yeah, we actually last night put out on our blog basically 4 signs for an investable bottom after yesterday. Again, down 3% day or almost 3% day, not that uncommon. So as much as it's been unvolatile this year, and that seemed like a big move, it wasn't really, and even the VIX only got up to a 24 handle. That's within one standard deviation above the average of 19 since 1990, so not too crazy. What we would look is, number one, look for the VIX to go above 30. So in Q4 of last year, the VIX did rise above 30, and that's really what got Fed Chair Powell's attention. And so we're looking for, number one, a VIX above 30, and then in the same vein of getting Fed Chair Powell's opinion, we want to really see Fed funds futures start pricing in over 50% chance of a 50 basis point cut in September. So as of last night, after a bad market day, it was pricing in a 60% chance of a 25 basis point cut, and a 40% chance of a 50 basis point cut. So we really think you need to look to when it gets to 50% chance where markets are really convinced that they'll do it. So that's number 2. Number 3 is already starting to happen. You really want to see China's currency start to stabilize. Obviously, the market's bouncing as of early this morning because of that. And then number 4, we really think track Bitcoin, the price of Bitcoin, even if you're not invested in it. Because over the past week, through this yuan devaluation news, it was up 24%, and it was up 7% within the first 24 hours of the yuan devaluation. That's because of capital flight that it causes. And so we think look for it to start declining, and that will signal to investors like China's doing now, stabilize their currency, but also to get more serious about really having trade talks with the U.S.
So you're looking for a VIX of 30 or higher, which another 3% down day could happen. You need a slight increase in the chance of a 50 basis point cut. China's currency to stabilize, which, at least today, this morning, it's stabilizing a bit. And then in terms of Bitcoin, you're looking for because those would all, I guess the first two would show maybe a bit of capitulation. The third would be fundamental ease, and then Bitcoin, that's also around China. This is also around you want to see Bitcoin sell off a bit to indicate that, more stabilization in China, less money fleeing China. Is that the idea?
Right, yeah, China's wealthiest citizens, once they believe that the yuan will stabilize more, there won't be as much capital fleeing the country.
Got it. So, all right, so we could, by the end of the week, we'll see. It could all come together, these four things.
I think we'll certainly see more volatility, but we're still bullish on the year. And again, back to that August 2015 reference that I spoke about. So from 2014 to 2016, earnings were pretty stagnant, kind of like they are now. But you had interest rates fall from 3% down to 1.4%. Right now, we're as of yesterday, we're down to 1.7% on the 10-year Treasury. So similar line, early in the year, going down over the past year, going from above 3% down through 2%. As long as you have falling interest rates, even though earnings are stagnant, we can certainly be up on the year. From 2014 to 2016, the S&P was up a total of 28%. Even with flat earnings. So even though we have flat earnings this year, and they've actually been pretty resilient given all the trade concerns, lower interest rates, and now hopefully the Fed will continue to ease, and we do think we can be up on the year.
All right, so we're ending on a bit of an optimistic note, and either way, investors know what to watch out for, those four signals. So Jessica, thanks so much for joining us, and I would just say, DataTrek Research does a lot of fascinating things. I love your guys' work. I love the research, the numbers, and also some of the storytelling you put into it. So anyway, congratulations on what you do there, and thanks for joining us here on Real Vision.
Thank you for having me.
So while she's not particularly optimistic about stocks between now and November, there are four signs that Jessica is looking for, which, if all of them hit, serve as a buy signal. 1, the VIX rising above 30. 2, the chance of a 50 basis point cut in September rising above 50%. 3, a stabilization of the Chinese yuan. And 4, a sell-off in Bitcoin, which would signal the end of Chinese capital flight. And for Trade Ideas, I'm Alex Rosenberg.